Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, August 26, 2022. I'll keep this one brief, doing an update on the equity markets here. After Powell's speech at Jackson Hole today, I told you there'd be some, little grind before it, and then some volatility. Undoubtedly, market hangs on every word he says now. I also had an update, a request to update wheat and Ethereum, and I was coincidentally just been watching wheat, looking at that today, so I'll cover that as well, and as well as the cryptos. Once again, for me, as of late, to be long or short the markets is to be long or short and or bullish and bearish crypto as well, because they are highly correlated risk on assets, meaning when there's risk on they're both rallying, and when we're in a risk off environment, like today, people selling equities, you see the risk on the risk off assets rally. That's Treasury bonds. I threw that as a trade idea yesterday. I'll do an update there, and of course stocks being sold down. So let's just dive into the charts here. All right, so no change. We rallied right up to kind of recap. Pivoted there on the low, closing all shorts, going to longs, looking for a rally up to the downtrend line and or the 200-day moving averages. So when you look at the daily chart here, you see the blue line is the 200-day simple moving average, and the red line is the 200 exponential. So I was targeting that. There's your primary downtrend line. There's the red line's the 200 simple, and the blue is the 200 the red's the 200 exponential, and it just moves a little faster with prices due to the way it's calculated. And there's a simple moving average. So we pretty much split the crosshairs there, and right between the two. And that was, that little box there showed you that was my bounce target zone, and so that's it. We're right in the middle. And, we use the 60-minute charts to kind of hone down our entries and exits and timing on that. And that gave us on this 60-minute chart, this is the one I've been showing, same chart, same levels for weeks. You had a divergent high here, a little divergent high with a little correction, pushed up, made a marginal new divergent high. Sell signal number one right there on the break of that minor downtrend line. This yellow line that comes through the screen is that primary downtrend line. So as I talked about, this whole thing, as I figured it would be, is a big old bull trap. Bull trap. That's the right term. Bulls buy that. They bought the breakout of the downtrend line, thinking we were going to go to the moon or whatever they were thinking, and it has failed. And as I often say, fewer things in trading are more bearish than a failed bullish breakout when you have a bullish setup or a break above resistance, because the reasoning behind that is you have new longs that pile in, new bulls that buy the breakout, and then once the breakout fails, they realize they were wrong. So they're either going to just sell outright because they realize the breakout failed, or their stops start to get hit. And then on top of that, you have the flexible traders like me that go long or short. The short sellers pile in, a small blood in the water, weakness there, and they do that. So that's kind of bigger picture. That whole, most importantly, I'm trying to drive home the point that we could have another thrust up, and we could still hit the 200 simple. I don't think it's going to happen because of the nature of this rally too. Early on, I was figuring we'd do something like this to get there, but we had just a straight, powerful, very sentiment got all ramped up and bullish. The street figured Powell was done, or they were even talking about rate cuts. I mean, craziness, right? The one thing that I've told you to keep an eye on, and we should continue to, is this. This is where Powell is powerless to be his natural dovish self. He's wired like his predecessor before him and her predecessor before her to be easy, flexible. We've had nothing but doves since I can remember. Print money. They're the heroes. Market went up, and they overdid it, and so now he's eating a lot of crow. He stayed too long too easy, too long, and stuck to his narrative that it was transitory inflation, and now he's behind the curve. So now we'll point this out. Then we don't have divergence, but there's a little wedge type pattern in DJP, which is one of my favorite broad-based commodity tracking ETNs. This is my real-time inflation indicator, and you can see here this is the juice. And I told you before it happened, and when it happened, that's what the narrative would be for the stock market rally, that inflation is abated. Well, we're watching this in real time, and that was just a correction. You strip away all my lines, all the levels. This is DJP. You can go back as long as you want. You can go to a weekly chart and see we've been in again, I'm kind of recapping a lot of what I've covered many times in the past. We're coming off a multi-year, even over a decade long bear market in commodities, and by every single metric out there, this appears to be nothing more than early stage bull market action. In other words, that bear market ended here, and this is pretty much the first leg up in a bull market. Oh, there's been a few corrections along the way, and that's all that appears to be right now. So again, this whole inflation thing, and and as incompetent as Powell and the Fed looks already, if they were to make the mistake of backing off too slow, I'm sorry, too early on trying to put a cap on inflation, it's just going to be a disaster. So, I think we'll see those little relief rallies along the way in the stock market. We'll see corrections along the way in commodities, but and we'll watch this. I'm not married to any one thing right now. I can tell you every metric shows it's a bull market, and the bull market's not over. Corrections are going to come. You get the divergences there, like that divergent high. That was our correction. There is a little trend line here to watch, but we're still above that trend line. We can continue up, and all right, back to the equity market. So that's what we're looking at, and he made it pretty clear today, and that's what knocked the markets down. You can see it here on a 1-minute chart. There's Powell started talking, and then they realized, oh gosh, this guy is really serious about trying to fight inflation by raising rates. So there was the knockdown, and let's talk about it from a technical perspective real quick. Turn off all the lines here on a daily chart. So this was the first leg down, and what I believe is more to come. I've given you my near-term targets. I'll cover those again on the 60-minute chart. And we had a little relief rally there, and the dip buyers stepped in, and they bought it now. So the day is still young, so I'm gonna monitor this, and I'll give you my thoughts if anything big changes. Right now we have a big old fat bearish engulfing candle that's wiped out both those previous 2 days where we had the rally. So all those dip buyers at this point in time are feeling pain. They got smoked. They bought the dip, and they really quickly got underwater, and so that's bearish. And you also engulfed those previous 2 candles, and we've also undercut the lows. So again, as I speak, it's 11:51 a.m. right now. This is pretty bearish, and if we close below those levels, we've taken them out. That's bearish as well. Let's go back to that 60-minute chart. Same levels I've given you for a while here. That red box right here was my bounce target zone I gave you yesterday. If you're already short, or plenty of reasons to have been short. But if you weren't, or you were and you wanted to add some short positions, I said between 319 and up to that intersecting downtrend line in 322.27 level, the gap right there. And you can see, zoom in nice and tight, we filled about 2/3 of it. So that was a very objective and so far quite profitable short entry. So what I want to see from here, when they pop a level like that, they may run up at it again. Bottom line is, you definitely want to see on this 60-minute chart, you don't want to see today's highs get taken out. That's going to show a lot of buyers stepping in here. Again, as of now, this is pretty bearish. Hard to call the micro squiggles. They'll probably kick it back at some point today, but let's watch how we close, and whether we close up in here today or below that level. The farther we get away from it, the more it's going to seal that. Effectively, we've taken out my 314.65 target from before. Remember, we hit that Monday when I was out on vacation. We traded around all for the next few days. We bounced up, ran at that gap, and got rejected. And now, since we've already had the consolidation there, now that we've taken it out, That should open the door for a move down to my next target here at about 308.83 right there. And then I'm still favoring a move down, what I call my initial swing target, minor, the zigs and zags and the squiggles aside, coming on down here to test this uptrend line off the lows right there. And then you've got also has some really nice support around 296.35. So that right there, the trend line down to about 296 and change is my current swing target zone. So like I said, that they take that out, well, I'll talk about it at the time. There's still the top of the gap just above it. Plenty of overhead resistance. Let's just talk about that if and when it happens. But as of now, I think you can, any rallies that you get, a half decent rally can be used to add to any short positions. And again, I'd really like to see us close today or tomorrow down well below that level. And if so, that's going to open the door to these next targets. One thing to add to, again, I'm very, very, very much open, more than I was before back here. And I did mention this as we came up here because of the nature of this move up. I'm very much open to the fact that that's the end of the bear market rally. We're not going to make another run at the 200s, and that this may just be a stop along the way if we have a reaction off that trend line, that we may be looking at a move down to new lows. What I wanted to convey here, my thoughts on this, I talked about back here. Remember a paradigm shift? I was saying we'd see that where all of a sudden you'd start to, everyone would think the worst is over, that the Fed's done raising and all that. Everything that happened and played out into that. Well, now there may be another paradigm shift where they realize that, oh man, this is not, Powell is. We are going to see higher rates. We are going to go into recession, and you can quickly. And that's the nature, by the way, guys. Go study any bear market. You got to go back in time. I'm not going to do it right here because I'm not prepared in this video. But go look at bear market rallies, and when they're over, it can be a pretty quick move down next time. And we can play the Elliott wave game if we want. Try to count wave patterns. I'm not an Elliottian, so no, not an expert in Elliott wave, but if this is going to be, let's say, a primary wave 3, could be pretty powerful. So guess what I'm trying to say is don't underestimate just how far and fast we could go down if that was the top and this is the beginning of the next leg down to, you got it, I haven't talked about my weekly targets in a while, at least a week or so, only because I've been out. But that's it. So remember, we hit T3, and there was every reason in the world to go long. Like I said, I hadn't seen more bullish charts, especially on the daily time frame on the indexes and all market leading stocks in quite some time. But I said, look, they're, yes, extremely bullish. Yes, we gamed, sheared most of the meat off that bone, going, covering shorts, going long. But in a bear market, those positive divergences on the daily chart do not lead to new highs and beyond as they do in a bull market. So if I am correct and we are still in a bear market, and this was just a bear market rally, yeah, it's going to be pretty quick down. So we already hit my third target. I have an alternative trend line there, but I'm still maintaining and have all along. T4 is the next stop in the bear market. That's about 235. Plus, we also have this long-term trend line coming in, so that they're going to come in close, depending on if and when we get there. And so that is from where we just peaked yesterday or whenever last week. That's about a 30% drop, and again, it can happen pretty quick. So just kind of heed that warning. Maybe we're not getting there. Maybe not. But don't underestimate how fast things can happen when all of a sudden there's a collective mindset, paradigm shift in the mass, public there, if you will. Okay, enough on that. Let's move on to crypto. You guys know the near-term targets, and you also know, my expectations and increasing likelihood that we're gonna maybe going down and undercut those lows and keep going down from there. And as such, if you're not a very active trader, and you shorted here, anywhere, here, yesterday, you can set your stops accordingly. I just showed you in percentage terms how much further that my next targets are, If you agree with those targets and 30% drop and you short it around here, you could use a 10% stop loss above that level, which would be way up here, and you're still using an attractive 3-to-1 risk reward. I know everyone has different entry prices, so you'd have to calculate. You have to do that on your own. Where do you think the cues are going if that's what you're shorting? And from there, okay, you say maybe you only are looking for a drop down to that trend line. Then you have to set much tighter stops if you plan to cover all your shorts there, and that's your sole target. Still open, also to the potential that we could come and hit that level and then go up and make a. I'm trying to draw my arrow tools here. Grab it here. Then we can go down there, hit that, and then make another run up and maybe go hit that 200-day simple moving average. We'll see. As of now, nothing but bearish price action today. Let's move on and cover those other things I told you I'd cover. And starting with crypto, Ethereum. This is a 60-minute chart. I'll get to the the futures and the actual crypto. ETHE is a ETF-like instrument. And there you had that nice, look at that beautiful bearish rising wedge on the 60-minute chart. Is it any coincidence that's what you had on the Nasdaq 100? Absolutely not. I told you they are a very highly correlated trade right now. Ethereum goes up and down more, has a higher beta than the Nasdaq 100. So unless this somehow changes this relationship, like I said, you can short or be long Ethereum instead of, or with QQQ, and you're just going to make more money, or you're going to lose more if it goes against you. But either way, I just want to point out it was a nice clean bearish rising wedge, move down, and these are my near-term targets right there. 1048-ish and 921-ish right there. Here's what it looks like on the daily chart. I wanted to speak to this a little bit. What we have down here, this whole thing is a island cluster bottom pattern. You have a cluster of candles separated by gaps on each side. That is in technical analysis, that is a bottoming pattern. And so I need to recognize that. And, I was pointing that range out at the time. We popped above it. So, maybe it's possible that at some point people start buying Ethereum, even with the stock market going down as an alternative. That was what way back when, a couple years ago, even when Bitcoin first came out before Ethereum, that's what people talked about, an alternative to the US dollar, alternative to stocks, somewhere to put your money. But so far, like I said, it's had a almost perfect correlation with the stock market. So I'm going to trade it and treat it as such. If you're a longer term investor in Ethereum, I can tell you really don't want to see move down, obviously not below that cluster down there. Near term, I think we're going lower. There's some support about 1049 on the daily chart there. And let me show you the crypto futures. That's what I'm trading. That's what I'm short. That's my pairing that up with my RTY and NQ shorts. And this is ETHE. Let me just size this chart for you real quick. ETHUSDRR. Let me make sure that's, I just rolled mine today. Bear with me one second. Yeah, the September. Okay, so the August was the last one. That one's about to stop trading. So here's the September contract. And you had this. This is a 60-minute chart. You have the divergent high. Let me show you another one. I think I marked up the 60-minute or 120-minute chart here. Yeah, I did. Okay, this is what I was showing you before when I had the August, and I transferred my lines over to the September. So there's a downtrend line that we broke above here, but that breakout, as I suspected it would, because the stock market failed to. That was a bearish rising wedge. There's, my lines are disappearing, or I didn't put them back over. Negative divergence. That was a beautiful bearish rising wedge with a divergent high breakdown, and we've been moving lower. Now, this was a back test of that trend line. If Ethereum fails that breakout, meaning comes down below the trend line, that's bearish. Big support level there, 1260, and that's that same trading range right there. So if you want to buy Ethereum and the charts confirm, or the stock market looks like it's going to rally, that's where you can step in. 1260, a little bit above there, that's going to be big support. If it breaks, pretty dang bearish, and if we break the bottom of that range, even more bearish. So that's kind of, these are the levels for Ethereum. Bitcoin, I've been trade that too, but lately I've just been pushing this one because it ran up a lot more than Bitcoin recently, so I figured it had more to fall. But here's my Bitcoin chart, 6 months, and you can see BRR, Bitcoin futures. There's the downtrend line as well. Similar to Ethereum, you had that little, not little, nice bearish rising wedge on the 60-minute chart, complete with negative divergences. And then what I'm going to probably do here is add a secondary trend line. You can see we're starting to crack this one. Here, I'm going to zoom in a little tighter for you. 2969 is price support. I have a line right there, roughly, give or take. And we're starting to crack that, as well as this uptrend line I have right there, right? But I can draw, I should say, and I'm going to add it right now, a line that comes in right here, and that's the BOD, or benefit of the doubt line. You have that reaction low, the low so far this year, another low there, and we're right there now. So Bitcoin takes that out, it's not going to look good. We've already taken out price support. We took out that other trend line. But I will say I would not short this one here. In fact, I'm going to have to revisit my Ethereum because I'm seeing, as I'm doing this, nice positive divergence potential. Now remember, this is what I call potential divergence. We could keep going lower and take that divergence out, but if we can hold here, if Bitcoin can hold here, that is, it can put in a divergent low in the 60-minute chart, and that could give us a nice rally. Let's see if there's a trend line to be had down here. Yeah, there is. So I'm going to draw this little wedge here. Yeah, that's conflicting analysis. Well, I showed you we didn't break that secondary trend line yet, and so there's a potential for Bitcoin to rally. And I'm going to revisit Ethereum. If I see anything I missed in the video right now as I was covering it, let me just jump over to it since I'm doing this for you. Ethereum, where did I put it? Here it is. Yeah, I'm going to put a line right there for sure. That's the top of that, or the bottom of that gap right here. I'm going to show you why I put that line there. Gap, reaction. It's not super good support, but it is decent support. And just like Bitcoin on this 2-hour 120-minute candle chart, you do have potential divergence. I say potential. Number one, you have to make a lower low, and in doing so, if you come down to maybe that 1443 level and then bounce and reverse, you could put in a divergent low there, and we might get a bounce there. So I'll continue to update this. I'll keep these guys on my radar. Like I said, I am, I'm short Ethereum, so I'm certainly keeping them on my radar, and I'll let you know if I have any changes. But there are those levels to watch, the back test of that trend line there, and 1443 of support. Okay, as per requested, this is wheat. This is a 2-hour chart, meaning 2-hour candles, 6 months of price history. You've got a downtrend line, not super well defined, but decent. You've got the highs there, reaction there, and down below you have some nice divergences forming here on the indicators. Hearing about corn crops, having a hard time right now with the drought, a lot of heat, things there. And again, we're in a bull market in commodities. So when you see divergences, bullish falling wedges, there's some not major but minor price resistance about 1824 and a quarter. So a pop above that we could run. I'm not even, targets would be pretty high. That's a pretty large wedge. If you take the widest part of the wedge, which is right here, and okay, you do this and add that to where it breaks out, that's where we'd probably be heading, somewhere up there. Let me give you a target if you want to swing wheat. And the ETN for this is WEAT. That's 1027 would be my swing target for there, with of course the usual stops along the way. Look for these reaction highs. I think you probably come in a little shy of that one right there. There's some minor resistance right here as well. That'd be your first target, but like I said, you break out above that pattern, I'd be more apt to hold that one and swing it up, and probably try for a shot up there to that 10, just shy of that 1027 resistance. Last but not least, an update on Treasury bonds. I'm going to cover ZB. It's a futures, is what I trade, but if you don't trade futures, TLT would be your ETF. I'm going to resize this. Yesterday, I think it was. Yes, it was. I pointed out this little wedge type, almost a channel there, but with positive divergence. We had a breakout, hit that first target zone right here, had a reaction as expected, powering up. Now we're at the top of the target zone. The fact we already had a reaction off at once, I expected to break, and I believe I laid this out as my preferred swing target. 139, 313, a little shy of that resistance level. So I think there's some more upside there. You gotta watch it get a little bit of negative divergence forming there. Now, why are treasuries? Well, they're not rallying today. They're up. They're down 0.05 and but they're holding up, and that is because number one, they're a flight to safety asset. They were down earlier, and they've by the way, they were down this morning, and they rallied on what Powell said. So you're seeing two tailwinds to being long treasury bonds right now, in my opinion. One, the risk on thing, where you have hedge funds, institutions, those institutional traders, pension funds, moving into treasuries as a flight to safety because stocks are getting beat up pretty good today and will probably continue to get beat up going forward, if I'm right. The other thing is, you might say, well, Randy, Powell just made it pretty clear he's going to keep raising rates. He's not letting off the pedal yet. Yeah, Powell doesn't raise the 30-year bond. He doesn't he doesn't control that rate. The market controls that. He controls the federal funds rate, the rate that money is loaned to banks on an overnight basis. And so he controls the shortest of short-term rates. And by raising short-term rates, and he even acknowledged today, he used a word, he warned the general public they'd be looking at probably some pain here. What happens is he's going to, it's not what he wants to do, but he may tip the economy into a recession. I think that's pretty much baked in the cake right now. I'll get to one other chart and we'll wrap up and I'll show you that. Anyway, so what happens there is, even though he is raising rates on the short end, that should bring rates down on the longer end, because that would imply, assuming that he's successful, rates go up, it curtails or slows economic growth. It brings growth expectations down, along with inflation expectations, and those two things, lower expectation of both inflation and economic growth, will cause long-term rates to fall. And remember, long-term bond rates, prices and rates move opposite. When interest rates fall on the 30-year bond, the price goes up. So there it is. That's my fundamental and technical reasoning for being long treasury bonds right now. Long-term bonds, that is, to be very clear, not short-term bonds. And last but not least, we have the yield curve. Covered this one quite a bit in the past. I'm sure most of you have heard of it. It is considered one of the most reliable indicators for an upcoming recession, and an indicator that is not a lagging indicator, a coincident indicator. It is a leading indicator, meaning it gives you advance notice, not, hey, real time or after the fact notice, like a lot of things do. And that just shows you when the yield curve inverts. That just means here's the yield curve when short-term rates drop below long-term rates. When long-term rates drop below short-term rates. So this one is the spread of the 10-year Treasury bond against the 1-year Treasury bond. And you can see here all these gray areas. If you can't see it, this is Guru Focus, GURU Focus.com. You can go there and find their yield curve. It's a pretty, I like to use this site. These are gray areas there, are recessions, and you can see, hopefully you can see it in the video, it's had a 100% effective rate where the yield curve inverts first, then the recession comes. COVID hit, you got the inversion, you had a recession that was so small, it's there, it's that gray line, and you might not be able to see it if the resolution on your monitor is not good, but it was there. And there it is. You can see it. And there, look, we've inverted more than we were back then on the 1 and 10 year. Here's the yield curve on the 210, meaning the 10-year Treasury. Oops, I made a mess here. Okay, now you can see it. So the 2 and the 10 showing you the same thing. There's 19 before the recession, the early 90s, dot-com bubble there, followed by recession there. There's the financial crisis right there back in 07, 08. and COVID, you tapped it right there. You inverted briefly, a little recession, and look at this. So the 2-year is right now, or the 10-year yield is well below the 2-year yield. So that's saying recession. So that's it. And so there's just a mountain of evidence pointing to me that the worst isn't over and that we're in a bear market, and we just may have completed a pretty good bear market rally with another leg down to come. So we'll wrap it up here, and if I see anything else that stands out, I will make a point to get it out to you. Otherwise, let's just sit back, see how the day closes. But right now, like I said, nothing but check marks for the bearish case today. This has been Randy Finney with Right Side of the Chart. Have a great day.